All right. Well, this is Andrew Stotz. สวัสดีครับทุกท่าน I'm excited to present to you tonight about the AWS strategy. If you're in here, say hi in the chat. I see Nam Tip there. Okay. And welcome to all of you guys. I have some cool new research that I want to bring to you, some new stuff that we're doing. I'm going to go through all of that, and I'm going to walk you through what's going on with the all-weather strategy. And, you can ask any questions about why am I doing this? Why am I doing that? And we're going to talk about many, many topics. I see a lot of people here. Kuna Tip, yep, Demo Cafe. Sompon, welcome. CNG 1807RK, welcome. Wutisak, hi there. Tong, hi. Son, nice to see you. There's Better Dub. All right. And there's Chachada. Nice to see all of you. I'm super excited. It's Tuesday night, 7 p.m. What better thing to do than to talk about AWS portfolio strategy and all the things that we're doing. So today, I'm going to review a little bit of update about what's happening with our strategy and all that. But I'm also going to present some new research. I've been reading this really interesting book. It's called Safe Havens. It's a great book. And I was running in the morning the other day. And when I was doing that, I was basically thinking about listening to this book. And I was thinking about something that I wanted to do. I'm going to present to you some charts and graphs and some analysis that I've done around Safe Haven. So I'll be excited to share that with you. So I see we have 185 people on. Make sure to share it and get it out there. We want to get as many people on. And let's get started. I'm going to go into the presentation right now. So this presentation I call AWS Smooths the Ride on the Volatility Roller Coaster. So let's go through a little bit before we get into it in detail. So for those of you that don't know me, I've been studying, teaching, and working in finance as well as investing for 30 years. I've also now produced more than 450 podcast episodes about investment mistakes. And that gives me some unique perspective on risk management. And that's a huge part of AWS. How do we reduce risk? How do we reduce risk? It's a major part that I've learned from my podcasts. Of course, I live with my mom. She's sitting at the kitchen table right here in beautiful Bangkok. She just had her dinner. That's a picture of us from last year. But mom's probably going to wait up until I finish, and then we both go to bed about the same time. Now, I want to say thanks for your support. I appreciate the way everybody has entrusted us with the all-weather strategy. This type of investment strategy requires a lot of work to create, to update, and to monitor. If you were to come to my office and see the way that we do it, you'll see that we spent a lot of time building the structure around this strategy. So, great to see you again. And also, Niran, how have you been? Well, truthfully, I've been pretty good. I've been busting my butt, getting ready for the next Valuation Masterclass Boot Camp. And I know that some people will ask me, what is that hat on my light back there? Yeah, what's that hat on my light? Well, for those of you that know about the Valuation Masterclass Boot Camp, it's a boot camp. And this is what I wear when it's time to kick students' ass to get in and push through the assignments that we give. So now, let's get in. Now, of course, you can put in questions as we go along. I'll stop and talk about question. And I see that Delta says, what's your opinion about Kiyosaki? Rich Dad, yeah, Kiyosaki, right? About the big crash in October. I don't think that anybody can ultimately predict a crash. At this point, I'm still not overweight, but exposed to the U.S. And I'm riding with that momentum. But I would say I haven't seen the arguments, but I've definitely seen a lot of people talk about there's a crash coming. And I would say, yes, we have to be careful because there are risks out there. But for right now, I'm not going to call a crash in any one particular month. Now, strategies revolve over time. So I see Suti Sak, hi there. And also There's Anne, one of my students. Strategies evolve over time, which requires continued testing and research to assure that the strategy adapts to many market shifts. And we're always working on that. And so, we want to continue to deliver the best. Now, what we've got coming up is that to be able to keep up the work with all that we're doing, we're now increasing the minimum investment amount to 500,000. And basically then there's subsequent investments of 25,000. So it's a big change that we're doing. Now, if you're already invested with AWS, this change in minimum is not going to impact you. And if you have any question, of course, reach out to the Phenomena team. We've been talking about doing this for a while. So yes. All right. So I see Natawat, Safe Haven. Safe Haven, the guy's name, I forgot the guy's name, but it's not Nicholas Sparks, I don't think. But I can't go online right now to find it. Nikki Brown says, good morning from USA. Yeah, Spitznagel. Yeah, there you go, Spitznagel. Nikki, good evening from beautiful Bangkok, Thailand. All right, let's continue. Now, AWS is part of the 10-10 Double Happiness campaign, and you can participate in that campaign by just going and scanning that barcode. And I'll just put this up full screen so you can see it. And that's one of the things to keep in mind. And also, let me go over to my screen. Hold on. And for all clients who invest new money during the campaign period, you can get rewards through the 10-10 Double Happiness campaign. Now, we also have an AWS only bonus as well. Big bonus for anyone who invests at least 500,000 into the all-weather strategy from now until the deadline. We're going to announce the deadline a little bit later. But what is the bonus? I want you to go to this link, this Slido here. Just scan it. And on this Slido, I want you to select the bonus that you would most like to have. Please go to there, and I just included the link in the in here. So just go to the link in the comment section and take a look at that. I want you to pick out what bonus is right for you. We'll come back to that later, but please go in and scan that right now and ask. We want to ask you. We have a lot of things to offer, but we're going to provide one bonus, but we want to think about what's the right bonus is going to be most valuable to you. So please go and scan this barcode and go there and vote for what bonus that you would like to see. All right, let's get that bonus going. Okay, so while you're doing that, I'm going to continue on. And I'm going to talk today about the strategy and the methodology and our objective. I'm going to teach you about learning to live with portfolio volatility. This section is a section I just really did a lot of work on over the last few days, coming from that, from the book Safe Haven. Now, I do want to answer a question that I see right here from someone that says, let's just pull it up on the screen. Hold on one second. Let me get it there. All right. Today, U.S. market looks dim. I'm worried the U.S. market looks like China. Am I overthinking? Well, I think with AWS, part of what I'm trying to do is I'm trying to build a structure that has more than just the U.S. in it. It has other asset classes and other exposures. So I'm a little bit less worried about it. And I don't think it's not a great idea to have all of your money in the U.S. But if you had all of your money in the U.S. right now, yeah, I would start to get worried, and I would diversify some of that into bonds and we've done some diversification into commodities. Now, Nope says, I'm waiting to dump some amount of AWS during this October crash and earn bonus. Just can't wait. Okay. I don't know about that. All right. Chanya Ann says, I voted. All right. And I've included here the link to the Safe Haven Investing. Great book. Highly recommend it. It's a little bit complicated. If you're into statistics like I am, you'll really like it. But it doesn't have to be an expert statistic to enjoy. All right. And there we see the test TR or ERC. Hi there. Okay. Now, let's continue on with the presentation. I'm going to talk about the QE that never ends. My view is quantitative easing is never going to end. And part of that's because you can't taper a QE addict, someone who is addicted to QE. Now, just want to highlight only 10% of people have voted. So please vote now. The link I just put into the comments. So please go to that and vote. And then we'll talk about review of weights and the like. Hi, Treewood. Nice to see you. All right. So remember, you can ask any question in the chat. I'll do my best to get to that question as we're going through. And as we get to the end, I'll try to do more. So let's review the methodology. I've developed a methodology I call FVMR. And I use this diagram to explain it. And what you can see is at the top of this diagram are earnings. And fundamentals is the F. And that's really about the earnings or the profitability of the company. Next one is valuation. And that's at the bottom of the diagram. And that's really how the market perceives that particular stock. And of course, we'd prefer to have good fundamentals and cheap valuation. So that would be great in valuations. Kelly, VI coach, awesome. Thanks for voting. Anop, great to see you. Anop's fantastic. All right. How to manage asset allocation during inflation up. Okay. So there's a question that just came in. I'm going to look at that. So Supercon Nitti says, how to manage asset allocation during inflation up. The first thing I would say about asset allocation. So I'll just come out of this and I'll talk to you for just a second about that. I'll just try to answer that question from Supercon. When inflation is rising, really, in my opinion, your best bet is to own companies. Why? Because you have basically the CEO and the management team. They're dealing with rising costs for their production, but they're trying to raise prices on their customers or get more efficient. There's a lot of scope for companies. There's a lot of scope for companies to improve themselves. So your ultimate asset allocation in inflationary periods is business. The second thing is hard assets or real assets, like a piece of land or a house or something like that, tends to do well in inflationary times. And then, of course, there is commodities, but commodities really are a way to play the momentum of inflation. But that's some ideas. So I'll just pick some questions every now and then and stop. Also saying hi to you guys. There's Tapering. Great to see you again. Yep, not voted. Thank you. If you voted, please put it in the comments so I can know that you guys have voted. We've got 331 people here. I would love to see that you guys vote and we can really get those numbers up. Then I'll know exactly what type of bonus is valuable to you and ultimately also to your clients in some cases. So the next question that comes up is from Tong Maha Wong Wiriya. All right. So what's your view about China? China's it's just such a strange place when it comes to investing in the stock market. One of the things is that I've had a stock picking portfolio of Chinese stocks since 2016. Remember, I did my PhD in China. So I was going back to China back and forth quite a bit. And on a website there, I sell my strategy to pick stocks in China. And truthfully, that strategy's done really well. Part of it is I don't get caught up in the big caps. Remember, there's 3,400 stocks now listed in the Chinese stock market. There's a lot of good companies to choose from, but it's also really difficult. So I think that, yeah, China is a little bit of a worry right now, but eventually the Chinese will bring it back. So I'm not really that worried about China. Now, I do think that the Evergrande situation that's happened there is a serious issue. That the Evergrande situation basically is just the tip of an iceberg when you consider about the property market in China. There's many property developers that have a lot of leverage, that have a lot of debt, that are overextended. But remember, one of the things I learned from the 1997 crisis in Thailand is that every economic crisis is usually a property market crisis. And that's because property is the typical collateral for loans in the banking system. And so if the property prices go down, the collateral goes down, and that really hits the banks. And the Chinese government knows that they can't let that happen. And so I would suspect that they're going to try to resolve that pretty aggressively. So I'm going to move on then. I see Vanis says voted. Yes, please mark down if you voted. There's Nam. Nice to see you. All right. So now let's get back into it. I'm going to switch back to the presentation. And here we're just finishing up on FVMR. And let me just go into it. And we looked at momentum. I look at momentum in earnings, and I look at momentum in price. And then I look at risk related to earnings and risk related to price. Now, let's talk about the strategy here a little bit, the objectives of the all-weather strategy. And first of all, just keep those questions coming. I see Knock Noi says, can we use AWS as aggressive bucket for after retirement, which AWS won't be the only port for this? I wouldn't call AWS as an aggressive bucket. I would think some market timers and some others may be more aggressive. But I do think in retirement, AWS, I would say, is relatively safe. Also, I see there's Nataprit says, Sawadee krap, Andrew. Thank you very much. All right. And Kuntip says, I voted. Okay. Supergone has another one. How do you view US day value due to debt too high? US bond is also reserve of each country, which is mean each country's money will be valued too. How to link to central bank digital money? Okay. This is a bit of a complicated question. I'm just going to keep it simple, and then I'm going to continue on with the presentation. What I would say in this case is that I think that the US dollar will probably remain strong over the next 3, 6, 12 months as the US tries to hold on to its position as the strong safe haven. But eventually, I think the US dollar is going to start to get knocked down, and treasuries are going to get knocked down. Now, remember that also, Supercon, for many companies, many countries now, they're reducing their exposure. Russia has completely reduced exposure to the US government bonds, and China is also in the process, right? Okay, so Anna Tip says, where is the link to vote? Yes. Thanks. Alex, maybe you can help us get that link in there. All right. Saran says, already in AWS. Great to hear. Okay. Now, you guys have so many great comments that I get so excited. I got to keep on to the strategy here. Hold on. Now, the first goal is to capture most of the equity market's long-term growth, and then to blend in other asset classes to protect against most of the equity downside. Now, from an investor's goal, it's to provide investors a strategy that reduces the time they need to spend on managing their money. My idea here is that I don't want you to have to worry about investing time in picking the strategy. I'm going to pick it for you. Now, the question is, I see in the comments, what are we voting for? Excellent question. Excellent question. And let me just see if I can, don't know if I can copy that. So, but I think I'll put that back into the comments. What we're voting for is that I'm going to give a bonus for people that sign up new coming in. And what I want to do with that is I've got about 4 different bonuses that I'm thinking about, and I want you to choose which bonus you think is the best one. Now, I do want to mention there is a, you guys have such good questions that you keep getting me to stop giving the presentation. So let's just look at some of these. How do you think about new position in oil now for inflation heads? How many percent? I would be careful. I mean, oil is a part of commodities, but just betting on oil is a little bit risky. But generally, if you ask me about oil, I would say oil prices are going to go up and up and up because oil supply is going to go down and down, or at least not increase. And I don't think, no matter how much we want to reduce the fossil fuel consumption, we won't be able to do it that easily. So oil is an interesting trade. Should we increase the percent of gold in AWS? Well, generally what I'm doing is I'm trying to decide when to do that. If I try to decide and you try to decide, then you're kind of doubling up strategies, and you can end up not getting the return. So I would say wait until I move on gold. And all right, Ganlaya says hi there. And Duong says, I already invested in AWS. When is a good time to increase investment in it? Well, we've just done some rebalancing of it. So now is probably a good time. It's part of the reason why we come live now, because we've done some rebalancing. We try to answer some questions and then we go. So for your case, I would say that now is probably not a bad time. Okay, let's continue on. So now there's three drivers, right? We're trying to be global, we're trying to be long-term, and we're trying to be diversified. Global means we're investing not only in Thailand. Thailand is a tiny part of this overall portfolio. It's long-term, meaning we gain from long-term equity return while trying to reduce a portion of losses during equity market downturns. It's diversified across four main asset classes. Now, by the way, for those of you guys, do you know who these people are? Who is the man with the, well, I was going to say the man with glasses. Nope, they all got glasses on. Who is the guy? Who is the youngest one here? Do you know who he is? Who are these people? Does anybody know? If you know, type it into the comments. Who are they? Now, if you want to learn about valuation, we've got the 6-week online valuation masterclass boot camp. It starts in just about 3 weeks in October 25th, and it's really awesome. It's the only program that teaches you exactly how to value actual companies like a pro and get your dream job in finance. And the key thing about the valuation masterclass is it's for those people that really want to learn about how to value stocks. So if that's what you really want to learn more deeply, that's what we train in there. This is what my connection at a big US bank said about one of my boot camp students. He's got all the tools to be really successful. I'm floating his resume internally and to my entire network on LinkedIn. So we've got an offer for those of you. That's right. Nok Noi got it right. Peter Lynch. Nam says Warren Buffett. Right. And thank you for voting. Patra won. Buffett, Munger, and Lynch. Right. Sheba got that right. Maria got it right. Yep. Mr. Peter. Supergone said Mr. Peter. Yep. Thanks for voting for all of you guys. All right. So, yeah, all the best. They are the best. That's what Plun Poon says. I'm not sure how to say that name. Now, the special offer for Phenomena followers is that you save $300, which using this coupon code, just the word Phenomena. So remember that word. Use that word. I think we'll put a link to this in the chat. So if you want to learn how to value companies, then we can teach you that. And don't forget the Phenomena code. All right. So now this is an area that I've been doing some work on recently, and I want you to understand how to learn to live with portfolio volatility. When I was 23 years old, I didn't look like that. That's not me. In fact, I studied statistics and quality control with this man. He was 90 by that time, and I was 23. His name is Dr. W. Edwards Deming. Some of you may have heard of him. And he was the father of the quality control movement, and he transformed my life and my business. So I wrote a book about what I learned. That's me on the right, and that's Dr. Deming on the left. And that was when I was working in Los Angeles at Pepsi. And I even wrote this book about transforming your business with Dr. Deming's 14 points. In fact, I have that book right here with me, which I have that book and many others that I've done, but I've included in the show notes, or sorry, in the comments about this. I've got this in the comments so you can see the link to the boot camp if you want to learn how to value. And nope, Morley says you learned from the great. Yeah, Dr. Deming was amazing. And I've got a special announcement coming up as soon as it's made public, that something I'm doing with the Deming Institute in America, which is going to be a lot of fun. And I'll let you guys know what that is. So a big lesson I learned was to put less emphasis on volatility and outcomes. The slides that follow will help you think long-term and not get distracted by monthly portfolio volatility. putting AWS's performance in perspective is what I want. Remember, our objective is to capture most of the global stock market's long-term growth and to blend in other types of assets to protect against most of the equity downside. So I'm trying to make the upside a smoother ride. Now, the traditional 60-40, 60% bonds, 60% stocks, 40% bonds is kind of what we can compare AWS against. So we can use that to understand. Now, I want to investigate the return distribution. Now, I started this analysis by calculating the monthly returns of US stocks and bonds and various combinations of them. And this is from 1926 to today. Now, you may not be great at numbers, but just follow along and I'll teach you. In this study, we focused on the average return and the standard deviation of returns for a 60 portfolio since 1926. We applied the statistical rule that tells us that 95% of normally distributed returns lie within plus or minus 2 standard deviations from the average. I learned a lot of this in my statistics as you did, but I also learned a lot from Dr. Deming. Now, a wide distribution means higher volatility. Volatility is a standard measure of risk in finance, but for the long-term investor, volatility is not risk. In fact, we like volatility because when it goes down, we can buy more. When it goes up, we can sell some. Generally, more volatile investments have higher returns, but you also need to accept some higher level of volatility. So though high volatility can be emotionally painful, and a smoother ride to get to, is what we're trying to do, is smooth that ride to get to your investment goal is what we're trying to do. Now, the first thing I want to look at is, what if you own a portfolio of all equity over the period from 1926 to August this year? Basically, you would find that 4% of months had a return that was plus or minus 11%. What do I mean? Here you can see the distribution of return. And what I've done here is I've created, I'm gonna go to full screen here so you can see it. What I've done here is I've created this chart, and from this is a lot of data underneath it. And basically what I've done is I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 deciles. And then I've looked at the number of times. And so here we can line this up and say a little bit more than 400 of the times the monthly return of the US stock market was between -1 and 3.6. That's where the majority of the outcomes were. And we can see that this is what we call a normal distribution. That is a normal distribution. And 2 standard deviations above the average and 2 standard deviations below the average tell us that 95% of the time, the outcomes are going to be in between those 2 lines. So there was 1,148 monthly returns. There was 0% that was allocated to bonds, meaning it was only stocks. And the average monthly return since 1926 in America was 1%. Now, 95% of the time, the outcomes fall between plus or minus 2 standard deviations from the average. Now, I'm going to clear off the screen and get all that writing that I did off of the slide. And now what I'm going to do is I'm going to go to the next portfolio. And this is 80% equity. That means 20% allocated to bonds. So here was 100% equity. Here's 80%. And what you can see is that if we look at this yield curve, or this normal curve, it starts to get pretty steep here. And if we looked at all equity, it's kind of more flat, we can say. And it's more flat because we have more possible outcomes with equity that could be very high or very low. So now we go back and we see if we just blend in 20% bonds, we're going to make the outcomes seem less volatile. And what if we put 60% in equity, 40% in bonds? We would see that we get an even more narrow distribution here, much more narrow. And if we did 40% equity, even more narrow. And what about 20% equity, even more narrow? And that means 80% allocated to bonds. And finally, if we put all of our money into bonds, 100%, the range of outcomes on a monthly basis is going to be somewhere between -1 and 3.6. Now, I've kept this range these deciles the same so that we can just compare. So I'm going to go back to the beginning, and here we are at the first one, and I'm going to move the numbers here. Well, I'll leave that on. So we can see all equity, and then we can see 80% equity, 60% equity, 40% equity, 20% equity, and 0% equity. And that's the distribution of what we would call it. Now, Dr. Deming taught me to look at each data point as it comes. So we can plot each monthly return of the US 60/40 portfolio from 1926 to August 2021. This allows us to see each data point as it happened. So we're not going to look at this. It's not going to look like that. After 1940, there were few months. So here we can see over time, these were the returns. The standard deviation lines are based on this mean or the average return of a 60/40 portfolio since 1926. And there's been some extreme returns, particularly in the beginning of the period. And we can see some extreme returns here in 1987, 1998, 2008, and 2020. But generally, most of the returns happen. What Dr. Deming told me is that really, when you look at this diagram, you don't need to worry too much about the returns that are happening inside 2 standard deviations. He even said at times 3 standard deviations. But let's just say that 95% of the outcomes are going to be within those ranges. And the result of that is that it's just noise. So now let's consider the same data, but only since we launched AWS strategy. First, we're going to look at the chart of the monthly returns. And we're going to look at that chart of the monthly returns, and let's see what we get. So this is the same type of chart, but this again is for monthly returns, and that is the 60/40 portfolio. And we go from when the AWS portfolio started in March. And what can you see from this? If we look at this portfolio, the standard deviation lines are based on 60/40, and 1 out of 30 is about 3% of the observations. So it's even less than 5% that's outside of that. And here we can see AWS. And what I'm trying to say is that all of the ups and downs in the portfolio, in your investment life, all of these are just random noise. Even this looked like, oh my God, next, down, down, but then it came back up. So there's not a lot of meaning in this data. And what do I want you to learn from this? Well, basically, I want you to think about that we're trying to smooth the returns. We don't want a return that's up here. We don't want a return that's up there. I mean, sure, we'd take a high return, but if that means that we got to have a low return, we don't want that. Now, so if you want to see how volatile your portfolio would have been, just like last time, we've created a calculation, an Excel file that you can put in information about the weights of the different regions that you're in. And from that data, you'll be able to see your own chart of monthly returns and what it would have looked like. In order to get this, just scan this QR code and take a minute and scan this, or just go to valuationmasterclass.com/phenomena. So take a moment and go there and download that. So you've got that tool and you can start to play with it. All right, download that, get it, and then we'll continue on to the next section. There's a link in the comments, so you can click on that and just sign up to that, and you'll be able to get that. All right, so what have you learned? 95% of outcomes of a normally distributed process fall within 2 standard deviations above and below. Dr. Deming taught me that most data is just random outcomes and that we should not get distracted by this noise. A portfolio that was 100% US equity saw returns range from 43 to -30, while the average return was about 1%, the average monthly return. A portfolio that was 60% US equity, and that meant 40% bonds, saw returns range from 24 to -16. So we narrowed the range of returns, but we also reduced the return to 0.7 on average per month. But I'm willing to reduce the return a little bit if we can reduce the risk a lot. So we aim to reduce volatility of returns without too much damage to long-term returns and to not get too distracted by the monthly ups and downs of the portfolio. So in other words, ladies and gentlemen, jia yen yen. That is my message, jia yen yen. So let's go and look at some questions. Take a moment, and I'm going to talk a little bit and take any of your questions right now. Wutisak, thank you for voting. And for others, if you've got questions, make sure to put them in. We've got a question here. Navaporn says, do you think U.S. stocks will turn to a bear market or just healthy correction in this year? What about next year? I think eventually that the U.S. is going to have a healthy correction. And I would say that it's hard to predict when that's going to happen. Sometimes you feel like it's going to happen, or what's the Kiyosaki from Rich Dad, Poor Dad may say it's going to happen in October. It's possible. October has been a bad month for the U.S. stock market over many years, but it's also very possible that the Congress passes the budget, they approve the debt limit, and then they get on to business, and then even the Fed doesn't start tapering, and we just see the market continuing to rise. So I think that we are going to see it fall, but I don't see that it's happening right away. All right, Kid Kitty. Hello, Mr. Andrew. Nice to see you, Kid Kitty. All right, next. Tennyson says, in your opinion, is there going to be a crash in the bond market in the next 5 years? How is the degree of confidence? Well, first of all, Tennyson, the answer, I asked my mom, you think the stock market's going to crash? She said, of course it's going to crash. Everything crashes, right? Eventually everything crashes. So you do have to expect that you're going to see some crash. But what I'm going to do is just show you about the bond market for just a minute. And let me just go back to our presentation. And here I'm going to show you, I'm going to share my screen and I'm going to walk through this a little bit. Let's go back to this presentation. Remember, the bond market is much less volatile. Almost all of the outcomes in the bond market are between -1 and plus 3.6. So what does that mean? Even if the bond market crashes, it's not going to be a huge crash. So yes, it's possible that the bond market will crash, but I would say that's not going to be something that I'm going to worry too much about right now. All right, now let's continue on and answer any other questions. If you've got questions, make sure to put them in, and I'll do my best to answer them. So now let's see. Next question. Supercorn says, how will you view two funds in AWS which seem not perform like others? Well, first of all, what I would say is that when I think of AWS, I don't think about the individual funds too much. I think about the overall performance. And for the overall performance, it's a blend, it's a mixture. It's just like listening to the symphony and you hear the trumpet doesn't sound right, but the trumpet is just one part of the overall symphony. So I don't have much to say about the performance of Tisco AP or Tisco Gem myself. And what I would say, which Kun Supat says, jia yen yen. Just look at the overall portfolio performance. Now, Nope says, what would be your opinion on bond market in the next 2 to 3 years? Well, I think that interest rates are at their bottom. There's nowhere to go, in my opinion, but up for interest rates. I think that inflation is rising. So I do think that there's some risk in the bond market. But nope, you got to ask the question, why am I owning bonds? Why are you owning bonds? To me, I own bonds to protect the downside. I don't own bonds because I want to make a huge return or I want to catch the right timing for bonds. I own bonds as a way of protecting the downside in equity because I know when equity falls, bonds tend to rise. And that protects my wealth. And also it protects your wealth through AWS. But also, if the stock market falls, it's possible that bonds just don't move also. All right. So eventually, I think the bond market is we're at the end of a 30, 40-year rally. And I think that the bond market will start to be losing money over time, but that amount of loss is not huge compared to losing 20, 30, 40% of your money in the equity market. All right, next question. Why does AWS never have any REITs? The reason is because REITs don't add any value in AWS, because remember, the first thing is that REITs basically are already in the S&P 500 and they're already in the market, the big REITs. So we already have REIT exposure already in AWS. The second thing is that I have found that REITs perform just like the stock market. So it doesn't provide me any return that's different from the stock market. That's why I don't own REITs. Do you have any views? Now, also, I would just say, as far as REITs are concerned, you can check out what we talked about last week or last month on the video, because I did talk about REITs and why we don't own them. Do you have any views on Japanese equities for the next 10 to 12 months? I wouldn't say I have a strong view right now on Japanese equities. All right, I'm going to go back into the presentation and let's go and talk about the QE that never ends. Now, monetary policy is the policy adopted by the monetary authority of a nation to control either the interest rate payable for very short-term borrowing or the money supply, often as an attempt to reduce inflation or the interest rate, to ensure price stability and general trust of the value and stability of the nation's currency. That's the concept of monetary policy. Now, I've put together a chart here of the federal funds rate in America. Traditional monetary policy stopped working as the Fed started to bring interest rates to zero. In 1993, the Fed funds rate were brought down to 3%. In 2004, the Fed funds rate was brought down to 1%. In 2008, the Fed funds rate was brought down to zero. And once again, it's down to zero. Basically, old Fed policy no longer worked when interest rates are now at zero. When interest rates are near zero, the Fed just can't lower them anymore. They run out of bullets to get banks to lend. And the Fed needed some new tools, so they started quantitative easing. The Fed stopped relying on the banks and started buying everything to inject cash into the economy. So what is QE? Well, the US Fed started buying up all types of financial assets. When they consider doing QE, it is because the Fed is concerned enough about the economy that it's willing to intervene to put upward support on asset prices, employment, and inflation. So how does QE work? Well, in theory, QE sends a strong signal that the central bank is willing to do anything to pump up the markets. Now, basically, QE is supposed to increase cash at banks, which encourages banks to lend. And it increases demand for risky bonds, raising their price and lowering their yield. The increased money supply lowers the yields, causing capital outflow and a weakening currency. A weakening currency increases the attractiveness of exports, causing exports to rise. And fiscal, well, very low yields provides politicians with nearly free money. So they borrow and they spend it. And assets, it pushes investors out of risk-free bonds and into assets such as homes or stocks, causing bubbles basically in those assets. And wealth, rising asset value and lower interest rate encourages businesses and households to consume. And finally, investment. Increased consumption leads companies to invest in long-term projects to satisfy the demand. That's my summary for you of how QE impacts the market. So, do you like that summary? I think that that's a very clear, simple summary. So, there's two meanings to the concept of tapering. The first word about tapering is slowing monthly purchases of bonds. For example, if they were buying 80 billion per month and then they reduced that to 50 billion, they're still buying bonds, right? They're just buying less bonds. So they call that one type of tapering. The Fed balance sheet continues to rise and QE continues. It's just happening at a slower pace. The key here is the signal, of course, that they're going to change direction. Now, the second type of QE is reducing assets on the Fed's balance sheet. This is when buying bonds turns to selling and reducing the Fed's asset holdings. So, This started 10 years after the 2008 global financial crisis. It took 10 years before they could start to unwind the QE. So here we can see a few points. The first point, I'm going to get my pointer. In fact, I'm going to show the full screen here so you can see it. And I'm going to grab my pointer. Let's first look at Bernanke signaled tapering. So right here, before we talk about that, that's when the 2008 crisis happened. And the assets at the Fed, that's what this is, total assets at the Fed, jumped. And then Bernanke signaled tapering in May of 2013. And what happened? Nothing. He actually kept buying, even though he said he was going to start tapering. Then we can see that in 2015, Bernanke started, that's where this line is, Bernanke started tapering, but it was a really slow tapering. And then in 2008, the tapering accelerated, and you can see that right here, where tapering started to go down. But then before you knew it, we had our next crisis, and we were starting to prepare for that here, and then tapering started to go up. And it's my belief that tapering basically will continue on for years to come. So the Fed buying government bonds through the banks, the Fed is prohibited from buying debt directly from the government. Instead, it buys U.S. Treasury bonds using the banks as the intermediary. The Fed now owns $5.4 trillion through this method. Now, think about it for a moment. It's an interesting thing to think about. Basically, the Fed cannot buy bonds from the U.S. government. It's against the law. It's against the rules. It's against the rules of the Fed. Now, how is it that the Fed now has $5.4 trillion of U.S. government bonds? They bought them through the banks. The U.S. banks are what we call primary dealers. The primary dealers buy the treasury bonds from the U.S. government, and in the past, they would either hold them or sell them to investors. But now they don't want to hold them, and investors don't want to buy them, so the Fed is buying all of those. That's the concept of QE that's going on, and the Fed has bought $5.4 trillion of these treasury bonds. QE sends a message to the government that there'll always be a buyer of their debt, and as a result, the government will keep on borrowing. Since they know that the Fed will buy every bond that they issue, of course, they're buying them through the banks. Now, this is important as foreigners are buying less U.S. dollar debt. We can see here the U.S. Treasury, they used to own about 35%, and now that's down to about 25%. Remember, I told you that China is cutting its holding of U.S. dollars. Russia is cutting its holding of U.S. dollars. Many countries are, and I think that we're going to see that this is going to continue to fall. And as that continues to fall, it doesn't mean that the U.S. government's going to stop borrowing money. It means that the Fed is going to have to step in to buy the U.S. government debt because the foreigners aren't buying it. Now, basically, the U.S. Fed is building up its holdings of mortgage-backed securities. It's buying trillions of dollars of mortgage-backed securities from Fannie Mae and Freddie Mac. These mortgage loans originate from the banks. Now, the Fed now holds $2.4 trillion of these mortgage-backed loans. And this also explains why we're seeing a bubble happening in the U.S. property market. And there's a pretty serious bubble going on in the U.S. housing market. Now, QE tells the banks there will always be a buyer of mortgage loans. Low interest rates, and QE encourages consumers also to keep borrowing to purchase their homes. Now, QE tells bond issuers that there will always be a buyer. The Fed announced what they call primary dealer credit, and it's different from 2008 subprime mortgage crisis. This provided 90-day funding to primary dealers. What does it mean, primary dealers? Those are the banks that the government, right? The government is issuing bonds. They're selling bonds, and they're giving those bonds to the primary dealers, JP Morgan and those big banks, and those guys are giving the government cash. Well, the Fed wanted to make sure that they're very liquid, and in this case, it wasn't just the government. It was corporate bonds that the Fed was getting involved in. This is the first time we've seen the Fed really get aggressive in buying corporate bonds. And so this action, or supporting the corporate bond market, was significant. Now, the next thing that we saw was corporate bonds, and in this case, in the secondary market, so corporate bonds in the secondary market, and they said that they would buy those, and they did that through this. So the Fed loaned money to this SPV, and Treasury put up $10 billion in capital. So let's just look at what happened here. Basically, the Fed is not allowed to loan money into companies. So instead, they had the Treasury, the U.S. Treasury in Thailand, we would probably call it the Revenue Department, but they had the U.S. Treasury set up a special purpose vehicle, and then the Fed injected loans to that. So it's a little bit of a sneaky way of getting around the requirements. Now, I'm going to take a minute and take some questions here. I see Tapering says, Jay Powell recently concerned on inflation. Is it a signal of tapering sooner? Definitely, the market is talking about tapering. And I think that the Fed is going to be talking about tapering, saying that they're going to do tapering and all that. But what my point is they're going to talk, but they're not going to eventually do it. Think of a heroin addict, and the mother and father says, we're going to stop them from using heroin. But when the child is suffering and they're calling out for heroin, the parents will give it to them. That's what's going to happen in America, in my perspective. They're not going to be able to stop QE. They're not going to be able to taper. Next question. What's the worst case market? The bond market collapse. Is it a high chance of happening? I would say that the bond market has had a long run, and it is you've got very low rates, and if rates start to rise, the bond market could fall, and you could see a minus 5%, minus 10% performance in the bond market. That's something that's possible that we could have in the bond market. But even at a minus 10% fall, it's still relatively strong protection against an equity market fall that could be 30, 40, 50%. Now, Kitty says, if I didn't invest in AWS yet, when would be proper time to start investing for the first time? Right now, we've just rebalanced the portfolio. So the information is out there. I'd say now is probably a good time to do it, and ask any questions that you have. All right. Jan says, voted. Thank you so much. Anulp says, what is going to happen when everybody, including the Fed, stops buying government bonds? Well, you can imagine what's going to happen is government bonds, there's going to be no buyers. When government bonds have no buyers, foreigners are not buying, the Fed doesn't want to buy, nobody wants to buy, the price of government bonds are going to start to collapse. And when that happens, then the yield on government bonds is going to rise, and interest rates is going to go to 3, 4, 5% for government bonds. The Fed is going to do everything it can to try to stop that. And that's the reason why I don't think that we're going to have any strong tapering, because of the fact that it would crash the bond market. That's my idea at this point. No, feel free to ask more questions if that didn't clarify what your question was. So let's continue on. And basically, QE encourages government to borrow and spend. And these government specialized or sponsored enterprises like Fannie Mae and Freddie Mac, they signal to individuals to borrow and spend, and corporations get encouraged to issue bonds and borrow and spend. So what's next? That's the big question. What is next? And I'm just going to pull up there we go. So what I would say is that if the market starts crashing again, what else will the Fed be able to buy? Government bonds, mortgage loans, corporate bonds. And next, I think that it's going to be stocks. And that's the reason why I'm hesitant to call a crash in the U.S. stock market like Kiyosaki. Kiyosaki is saying there's a crash, but I would say that if things started crashing and interest rates started rising, I believe the Fed would potentially start to buy not only corporate bonds, but actually corporate equity. All right, some other questions. Nam says, can I DCA with AWS? Yes. AWS, I think, is suitable for DCA. Yes. Santana says, I love commodities in the AWS portfolio. It's green. Yes. All right. Keep those commodities going. All right, let's continue on. So I'm just going to skip through this, and I'm going to go into something that I call the, let me just get rid of that. Hold on. There we go. Yeah, Kelly VI says, I think QE will be forever. It's just more or less. I don't see how the Fed would reduce the balance sheet. I think you're right. That's the message, Kelly. You said it very clearly. That's the message I'm trying to get across, that they're not going to be able to stop QE even though they want to. It's like stopping eating donuts, right? We don't want to stop eating donuts. And here is a crying baby. Here's a baby crying because he didn't win. And to relieve his pain, he gets a trophy. Parents want to make him feel better, like everybody's a winner. But next time he faces a loss, a trophy isn't enough. Then they give him candy and even durian. He loves the sugar rush he gets from candy, and you love the way the candy instantly makes him happy. So with any failure, loss, or adversity that you give him, candy, you can make him happy. Now, the point is that losing sucks and it hurts, and we want our kids to be happy. If you could do something to make sure your kid avoided the pain of losing, would you? What consequences would your kid suffer in the future if you did this? Imagine you've been rewarding your kids with sweets all their life. Here's one of the consequences. They can get diabetes. Now, the bigger reason that the Fed won't taper is what I call the spoiled brat theory. Companies and stock market investors are the biggest brats. Workers and the small guys are left with scraps. And the spoiled brat theory basically says we have all seen a spoiled brat. He cries and screams if he doesn't get what he wants. In the old days, dads used to say, quit your crying or I'll give you something to cry about. Nowadays, many people have been conditioned into thinking the government's role is to prevent pain. But without pain, the market is not free. We need pain in the market. You're harming your baby's long-term health by giving him candy all the time. The spoiled brat wants candy, and the U.S. government will continue to give it. If the Fed started to taper and the market started reacting negatively, then I believe that the Fed would reverse course. And the Fed and the U.S. government, in my opinion, are bad parents. If candy is not enough, the Fed can always support the market through the SPVs that we've talked about that BlackRock manages. So what is the bottom line? U.S. government debt is massive, so politicians want to keep rates low to reduce government interest burden, which will squash government spending in other areas. Americans have been spoiled for so long that the Fed can't stop giving them candy, and the Fed will do anything to keep the spoiled brat from having a taper tantrum. So the bottom line is inflation is likely to continue, and the Fed is unlikely to raise rates aggressively to stop it. I expect no Fed tapering. Now, we'll talk a little bit about the performance of AWS, and then I'll take some questions. So since inception, we're up 9.5% per annum per year. And 10 months of 2019, we were up 10.8. 2020, we were only up by 3.4. 2021, we were up by 11.6 year to date. So let's understand the performance. In the past month, AWS was down, but outperformed a traditional 60-40 portfolio by about 1.6%. Commodities were our best performer. Second best performer was developed in Europe, but it still didn't perform that well. If we had picked Japan, we would have seemed really smart. But that's part of the process of picking sectors and stocks. The U.S. was the worst performer. We didn't get anything out of that. Now, the past 3 months, AWS has beaten a 60-40 by about 2.2%, at about 1.5% up in the past 3 months. And over a year, we've beaten the 60-40 by about 4.9%. That's our objective. And here you can see the performance in the chart, and we can see that AWS basically has had an allocation of 40 to 65% equity over that time. And since the 2nd of March, equity has been 65%, bonds 5, gold 5, and commodities 25. We've held this position for a while. We've reduced downside compared to an equity-only strategy. And here we can see the volatility. That's what we're looking at in this particular case. and the annualized volatility is 10.4 for AWS versus 12.8 for 60/40. And if we continue on, what we can see is that on the worst days, let's just look at one of the worst days. So one of the worst days here we can see was when the 60/40 was down 5.6%, AWS was down less. And in here, this is the part about AWS that really makes a difference. When the market, when 60/40 was down 6.4, AWS was down less. When 60/40 was down 4.5, AWS was down less, 3.7 less, 3.3 less, 2.9 less, 3 less. Here we have our first case where AWS underperformed in a down market, and here it was almost flat, and then AWS less. Ladies and gentlemen, this is the key to AWS. What we're trying to do is make sure that we don't have these extreme loss items, because we know that you are trusting your money and your long-term family's money to AWS. And when you do that, we want to make sure that you understand this strategy basically is trying to protect against the downside. Let's take some questions here. All right. What do you think about debt ceiling in the U.S. and will there be any default in paying debt as the market is has us concerned? I just think there's a lot of politics involved, and the politicians are just fighting it out. And the result of that is that they are using the debt as a way to negotiate. And it looks very ugly, but I think that they're going to extend the debt ceiling in the end. Next, okay, so question number 2, which we put up, there's a second question. There's the link to it in Slido. Go to it and please vote of whether we want to give a big bonus to our subscribers. We want to pick the right topic that you're most interested in. And most importantly, we want to understand whether you want to do it by video that's recorded or by live. So please go to the link and give us your vote so that we understand what you want, right? Again, question number 2 is you want it live or recorded. All right. Now, Kitty says, how long will very low interest rates last? How do you think about low rates affect on market and economic in the long term? Well, Kitty, I think that low interest rates are really bad. Basically, we're destroying the meaning of the price of money. We're destroying people's ability to price risk. And that's why I don't like that the interest rate is down so low and it's controlled by the government. But unfortunately, I don't run things around here and I have to follow along. And what I would say is that they're going to keep interest rates as low as they can for as long as they can. And even if inflation starts to rise, I think that the Fed can't allow interest rates to rise too high because it's going to cause the interest expense for the US government to be massive. And it's going to slow down the economy. Now, what if a new dad, not Powell, would this accelerate Fed QE tapering? No, actually, pun, I would say just the opposite. If a new Fed chairman comes in, they're going to be part of modern monetary policy or modern monetary theory. And they're in the theory of we want to spend and we want to keep interest rates low, pump a lot of money into the economy. So I don't think that we're going to see that tapering is going to happen. I think it's going to be the opposite when the new one comes in. Next one, Mai says, how much return should we expect from bonds in the next few years when the Fed funds rates tend to rise? Is the negative duration a good strategy for this situation? I would say if you're investing in bonds to try to make some good return, I would be very careful. Bonds is not where you're going to get good long-term returns. It's going to happen through stocks and through equity. So just be careful what you're doing. As far as duration is concerned, basically, if you think that interest rates are going to rise, you don't want to own a 20 or 30-year bond because they will have a much more significant fall in their price. You want to own a very short-term bond. Now, you can look at some negative duration, but I'm going to leave that for another day. That's a little bit complicated, you're very sophisticated. But generally, if let's to go back to this, generally, if you think that interest rates are going to rise, you don't want to own long-term bonds, you want to own short-term bonds. But if you think that interest rates will rise, you don't really want to own bonds because bonds are going to go down. But remember, bonds have a function in a portfolio, and that is to protect the downside. Kelly, VI Coach says, I'm interested in your valuation masterclass. Is it a live online class? I've got a mission to do the CFA exam. That's awesome. CFA is changed my life. In fact, the CFA, my CFA is on the wall over there. The valuation masterclass is 6 weeks intense. You're going to value 4 companies, and you're going to do a final project, and you're going to present that project. You'll be assigned to a team that you'll be working with other people who are either professionals who are already working or not. And you're going to basically, you'll have video content that you will watch on your own. And then you'll also have times that you'll join some of our weekly or daily events. So basically, there's a little bit of live, there's a little bit of recorded, but you can do it on your own schedule. All right. Ann says, AWS strategy is mainly concerned to capital growth or constantly return for a certain period. So AWS strategy is trying to get capital appreciation in the equity market and trying to protect against the downside. We're not trying to get some dividend or something like that. We're just trying to get stock market returns. All right. Now, Phenomena, here we say, create your all-weather strategy portfolio at the link here, and you can read more about the strategy. All right, next one. We got some good questions. Not to point us maybe out of the topic scope, but what is your view for China in middle long term, as the short term seems to be extremely volatile? My answer is the long term is going to be extremely volatile too, because the Chinese market is a wild ride, and it's not going to change. Chinese people are traders. They're trading aggressively in the market. And then the government comes in and takes some extreme action that can crash the market. Sometimes that can boom the market. I would always expect a lot of volatility in the Chinese market. And that volatility doesn't always come with higher return. So I don't think it makes a lot of sense to allocate too much of your money to China. Maybe 5%, maybe 10%, but I wouldn't allocate too much, because it's just such a wild ride. All right. All right. So we've got the link in here you can go to for the boot camp. Here's another one. JPAT. It seems the scenario is that tapering is still going on. Inflation is high, which interest rates is kept low. Negative interest rate is foreseen for a long period. What will happen if it's long? Okay. That's a long question there. So tapering could go on. There is no tapering so far. It's only talking about tapering. Let's say that inflation is going high. I think that that's going to be happening. And the Fed is going to try to keep interest rates low because of the damage that could do to the economy and the damage it could do to the federal government. And the result of that is they're going to try to keep interest rates low. Let's say the government bond yield on 30-year government bonds maybe, maximum 2%, maybe 2.5%. And then inflation's high and interest rates are low. We're going to be in a negative interest rate environment. That's what you're asking about. And yes, it could be actually negative interest rate environments don't usually last that long. And I don't expect it would be that long in America. But we do have some negative interest rate environment right now. And what I would say is that we're going to be in a negative interest rate environment for a while, because they're not going to raise the interest rates and they're not going to slow down the inflation. They're going to have to just live with it. So it will be negative. And if it's negative interest rates, one asset class that tends to do very well is gold. All right. So here's the coupon that you use. Remember, it's Phenomena for the boot camp, and you can get a discount. All right. Now, if you've got other questions, bring them on. I'm going to switch back into the presentation for just a little bit to go over a little bit more, and then we're going to wrap it up for tonight. I don't want to take too much of your time. There's so many things that I've been working on that I want to share. But basically, let's just look at the equity weight of the portfolio now is 60% equity, and that's where we've had it. So we didn't make any changes to that in this most recent time. As far as our newest weighting is concerned, basically you can see that we are the same as previously with a focus on US and developed Europe. Again, we've just done some, looking at the portfolio, and we're set for a little while. So I would say if you're thinking about investing, now is probably a good time. And basically, I've given a lot of things in here, but I'm just going to skip through that. And I'm going to look at the next thing. Right now, the weighting is on 5% bonds. So 65% equity, 5% bonds, meaning I don't see a crash immediately right now. Now I'm going to skip back through and I'm going to look at commodities. And here you can see we've been 25% commodities. And the result of that 25% is that commodities have done really well. Come on, there's a lot of inflation out there. We can all see it in our business lives and in our regular lives. And then finally, what we can see is that gold right now is at 5%. I think that in the future, that's probably going to rise, but not right now. Not right now. I'm going to go with what we see with commodities. Now, what are the risks to AWS? Well, the first risk is that I'm wrong and that inflation is, in fact, transitory. AWS is benefiting from rising inflation. That's why we're heavy in our exposure to commodities. So that's a risk. There's a risk that inflation is transitory, which could hurt our performance. Besides, return expectations in inflationary environments are based upon corresponding rising interest rates. But the Fed and ECB are expected to keep rates low, at least until 2022. Now, another one, of course, is variance related to coronavirus. And if governments do more lockdowns, equity markets could get hit. And of course, there's a risk of the US default. I've told you I don't think it's going to happen. But if the American Congress fails to resolve the debt ceiling and the US defaults, this could have very serious negative consequences for US equity and possibly global equity. And then recent German election is interesting. It may cause gridlock in Europe. The election results are unlikely to give any influence to the radical left and the radical right. And it may take some time for a government to form, and a fragile majority may lead to slower growth in Germany and in what is ultimately Germany is Europeans' economic locomotive. So to wrap it up, though down by 1% for the month, AWS beat a traditional 60-40 portfolio by 1.6. The Fed and ECB unwillingness to taper could drive equities higher. Commodities are driven by energy crisis and supply chain disruption. And also, we have risks related to inflation. And if it turns out to be transitory, we could be in for some trouble. So I'm going to open up for Q&A. Remember, if you want to try out the boot camp, you're going to gain real experience in writing a professional report, the exact skills to become a leading analyst, and come closer to either interviewing or getting a dream job. And what do you get? It's 30 hours of on-demand video, 15 hours of live valuation discussions. You'll make friends and build a network of financial professionals. You'll forecast and value 5 companies, and you'll write and present one of those companies as a complete equity research report. And you'll receive daily guidance and feedback to support your progress. And you'll have lifetime access to the course material. And you're going to have access to me and my team. You'll get a certificate of completion also. This was our presentation. And we have some of our graduates who are actually from Phenomena. So there's KP and Tossaporn. So remember, it's until October 10th that you've got to sign up. So now I'm going to open it up for any questions, and I'm going to go full screen. So let's go to some of the questions that we got. Kid says, if 5-year forward inflation expectation is lower than 5-year forward, will it happen in your I think that I'm not sure if I understand this question. You may have to rewrite it just so I understand it. What's your view about Asia ex Japan? Jirawet, I would say that I think that economically we're strong. We've got a good group of people in these countries. We've got billions of people across Asia that are growing in their income and their consumption. So there's a strong, vibrant economies in Asia. The problem that I see about Asia right now is that if the US market falls, Asia can be very volatile. And Asia has gotten a little bit more expensive, but generally I would say that Asia looks okay. Now, my portfolio is not heavily weighted in there. I'm weighting in developed US, developed Europe, because those countries are where they have the ability to push up the markets. I'm riding some of that momentum. Now, keep in mind, as far as that's concerned, Thailand, as an example, can't push up the stock market. If the Thai central bank, the Bank of Thailand, started printing money, eventually the baht would start devaluing in the global markets. And that's the thing that prevents them from doing that. But for the Fed and also for ECB, they're not facing those constraints. So I'm riding the progress, or let's say the momentum that's happening in those developed markets. All right. When is a good time, AJ says, to put money in AWS, before 18th October or after, or does it make any difference? I think that it doesn't make a lot of difference. Yes, the market could go up and down, but you're never going to be able to time it right. And so I would say start now, continue to add to it over time. Sometimes the market may crash, sometimes we may crash, but that's time to pick up more. And that's the concept a little bit of AWS. Pun says, your view on oil could go up to 100 this year, and if falling, vice versa, AWS will hurt from 25% commodities. Yeah, if the inflation story doesn't play out, if oil prices don't stay high, if demand for metals and other things don't stay high, let's say China crashes, yes, our oil view will hurt us, and our commodities view will hurt us. So that is a risk that we just reviewed. So if you think that oil is going to crash and commodities are going to crash, then you'd say you're going to be able to predict it better than I am. All right, let's look at another one. Sorry, I meant usually long-term inflation is higher than short-term. Right, correct. So long-term inflation expectation is higher than short-term. I wouldn't say that that's necessarily the case. Inflation expectation is kind of across the spectrum. So I don't know if that's exactly the case. I would say I'm not sure about that. Now, you may be talking about long-term versus short-term interest rates. And let's just talk about that. Imagine that long-term interest rates were lower than short-term interest rates. That is an inverted yield curve. And that's usually telling us that the economy is going to get hit. Supercorn says, how do you view ASEAN markets like Indonesia and Vietnam? I think those markets are interesting right now. For this particular discussion, I haven't prepared myself that much for Vietnam. I think that Vietnam is an interesting story. It's very expensive. Luckily, it's getting more illiquid, but I would say that it's pretty good. Now, another question from San. Is AWS similar to Ray Dalio's all-season portfolio? Can you discuss the difference? Yes, the difference is Ray Dalio is the man. He is amazing, and he's got billions and billions of dollars. My all-weather strategy is a little bit more humble. I am not as sophisticated, although I have a lot of quantitative structure as to what I do. I've definitely learned a lot from studying and reading Ray Dalio and listening to him, but AWS is not like a copy of Dalio's AWS, but I'm trying to reduce risk through AWS, and that one part is similar. So that's what I would say is the difference. I think we've almost run out of time. So if we've got any questions, just keep coming with any questions, and I'll do my best. I've now finished my presentation, and I want to thank you all for coming to this presentation. Again, I also want to thank you for voting, and we'll be in touch with you to make sure that we've got everything that you need that we can help with. That's the objective of what we want to do. We have a lot to share. Let's look at some of the other questions and comments. Sheba says, thank you for your fabulous presentation. I'm looking for your next one. You're welcome. It takes a lot of work to put these together, many, many hours of analyzing. And sometimes it's not that easy to make it simple. What I'm trying to do is make it simple. And, I'm trying my best. Is it a good time to invest in Japan today? I think Japan is interesting in my perspective, and there's so many interesting small and mid-cap companies in Japan. I would say it's probably not a bad time for Japan. Thanks a lot. I really appreciate Charles Moore Stotz. Now, Charles Moore Stotz is my grandfather, and you can find him on Wikipedia. He was a famous architect in America, and that's the reason why my name is Andrew Charles Stotz. My middle name is Charles, coming from my grandfather. Now, Kyle Lim says, in your opinion, what is the final episode of the U.S. economy? I don't know. I don't know where it ends. I mean, they just keep printing. They just keep spending. It's trillions of dollars now. I don't know where it's going to end, but I can say someday it's going to end very ugly. And I'm glad that I'm in Thailand and that we have the opportunity to invest around the world. Kitty says, thank you. You're very welcome. And Suti Sak says, thank you for sharing with a big heart. I appreciate that. Sending back a big heart also. And Nop says, always a great session. I thank you. I look forward to seeing you. Nop, Anne says, thank you. Splendid information. Nop, thanks. Your presentation is great as always. I appreciate it. As you know, I spend a lot of time trying to put these things together. Boom Charlie, thank you for sharing your knowledge. I just brought AWS in September. I'm now in the red. Yes, it goes down. Hopefully it can come back up. We're down a little bit, but hang on. Invest for the long term. That's what I'm trying to teach. What Dr. Deming taught me is the idea, don't get too caught up in the monthly variations. Poor Ahmed says, thank you. I'm FA that's often using it. Poor Ahmed, I appreciate that very much. Let me know if there's more that I can do to share it. Our SCBS 500 and KUSA, same. They're very close. I don't have a big difference in them right now for you, but they're very close. Triwat says, thank you. All right. Well, I want to thank you all. It's been a fun session, and I hope to see you in the Valuation Masterclass in there. It's kind of tough. It's a boot camp. It's tough, but our objective is to teach our students how to value companies and get it done. So again, Kuntip, thank you very much for increasing. And Nam, thank you for that. And also, Natapon, you are welcome. All right. You guys have a great evening. Relax. I'm going to go give my mom a big hug, and I'll say goodbye to all of you. Thank you again for your time and your willingness to be involved with AWS. If you have any questions, feel free to let us know. We'll be in touch. Have a great evening.
Phenomena จัดหนักจัดเต็มเอาใจนักลงทุนในงานมหกรรมออนไลน์รวมพลคนลงทุนปี 2021 รวมกูรูเจาะลึกทุกมิติครบทุกแง่มุมเรียกรวมพลติดอาวุธคว้าโอกาสสร้างผลตอบแทนในระยะยาวตอบโจทย์นักลงทุนทุกแบบทุกสไตล์รวมพลนักรบ DIY แนะนำกองทุนรายตัวสำหรับขาซิ่ง DIY กับ Mr. Messenger เทศกาลประหยัดภาษีสายลดหย่อนห้ามพลาดเล่นตัวไหนดีฟังงานนี้รวมพลนักลงทุน 1000X มือใหม่มือโปรอย่ารอช้าเจาะลึกกลยุทธ์พอร์ตฝ่ามรสุมเศรษฐกิจกับดร.เมธีมีเงินแต่ไม่มีเวลาให้กูรูช่วยจัดพอร์ตยิ้มรับในทุกสถานการณ์กับ Andrew Stotz รับชมสดผ่านทางเว็บไซต์และแอปพลิเคชันเต็มอิ่มตลอด3เดือนสุดท้ายติดตามโปรโมชั่นและรายละเอียดได้ที่เว็บไซต์ finno.me/seminar-2021